I joined the Trust as chair at the end of January this year. One of my first jobs was managing an investment trust, knowing how they operate in some detail, which gives you an insight into how investment managers think, what shareholders want, what makes a good investment trust and what makes a less good investment trust. So having looked at investment trusts and managed them for over 30 years, I think that might have been one of the skills which led to my appointment. I'm happy to be here announcing the interim results for Smithson Investment Trust, which covers the first 6 months of 2025. We have outperformed the underlying index, which is a satisfactory start given that it's my first interim report as chairman of the company. The discount on the shares of Smithson Investment Trust have typically ranged from about 9% to 11% over the last 6 months, which is higher than the board would wish. We would like the share price to trade nearer the net asset value of the company. So the benefit for shareholders is that each time one buys back a share, you buy at a 10% discount and then you put it into treasury, it adds a little bit to the net asset value. Smithson does buy a large proportion of its issued share capital back each year, and historically it has been one of the highest buybackers of shares as a percentage of its share capital. The board of directors have changed a little. Sarika Patel has been appointed as the chair of the audit committee. She has got vast experience in the investment trust world, but also in the public sector and other commercial areas. We've started the process to add a fifth member of the board, and we would hope that that position will be filled within the next few months. Smithson Investment Trust paid a dividend, I think for the first time ever last year, and that is the result of us having to comply with certain rules. One of those rules is that we're only allowed to retain a certain amount of the profits we make each year, and anything above that we have to pay out. And last year, the revenue from the dividends received from the underlying companies in which we invest exceeded the costs of the company. In the first half of this year, the income was once again a little bit ahead of expenses, but we feel it isn't appropriate at this point to declare a dividend and wish to wait until the end of the year to see again whether revenue exceeds expenses. One of Smithson's unique factors is that if the discount averages over 10% in its financial year, there is a continuation vote at the following annual general meeting. The board is committed to having that continuation vote every year if the average of the discount is over 10%. We are inevitably affected by geopolitical events around the world. However, one of the great things about Smithson and investment trusts as a whole and their closed-end nature is that one can ride through these times of volatility by investing in good, medium to longer term, growth-orientated companies.
Smithson's performance in the first half of the year was good, with our reference index, the MSCI World Small and Mid-Cap Index, down slightly. Smithson portfolio was actually up 2.4%. Now this is a combination of some macro headwinds abating, like higher interest rates, but also we had some exciting developments in the portfolio, with names such as Oddity and VeriSign also performing very well. We've tweaked a couple of elements of the Smithson investment strategy over the last year or so. One is to focus more on smaller companies, and the other is to focus on areas with prominent growth themes that we expect to continue for the next few years, but within our standard sectors of consumer, healthcare, industrial, and technology. One example of this is NAPCO Security Technologies, which is a US producer of access control products, including locks, control panels, and alarms. It's actually the smallest company that we've ever bought. Another example is Vertiv Holdings. This produces liquid cooling systems for AI data centers, clearly a very prominent growth theme. And finally, Medpace, which is a outsourced provider of medical research specifically for small biotech companies, which is the fastest area of medical research. All of these companies have performed extremely well since we acquired them, so clearly have benefited the overall performance of the portfolio. Let me talk you through a few top contributors and detractors during the period. Oddity was actually our best performing stock, up 76% in the half. This has been somewhat of a conundrum because despite the fact that profits in the last 12 months were double that of the profitability in the period before IPO just 2 years ago, the stock had been relatively flat. This all changed last month when the company reported very strong results showing excellent growth, and this time the market reaction was quite strong. And it just goes to show another example of stock market performance coming like ketchup out of a glass bottle. Initially, not at all, and then all at once. Our leading detractor was Clorox. Now this is quite surprising to many because Clorox, being the producer of household staple goods, typically also have a very stable share price because of the consistent demand that they experience. However, in the last few months, they have reported that they've suffered from a weakening of sentiment in the US consumer, which has led to a decline of 2% of their revenues. And they also suffered around $100 million of extra costs from the new tariffs implemented by the US. There's been some change in the positioning of the fund in terms of sectors and geographies. First, the changes in the portfolio by name mean that industrials has actually fallen as a percentage of our weighting down to 33%, while healthcare has increased slightly up to 17%. In terms of geography, I've often been asked in the last few weeks whether I'm allocating capital away from the US because of the obvious erratic policy making, the slowdown in growth, and also the devaluation of the dollar. Now, interestingly, the US is still the largest market in the world, and it's a very interesting place to do business. And because of that, we find the largest number of high growth, high quality, small companies. And that's because for smaller companies, the domestic market is far more important than international markets. So actually what this has meant is that during this uncertainty that we've suffered, we've been actually able to buy more of these high growth, high quality companies, and now at attractive valuations. So all that means that our allocation to the US has actually gone up slightly to 51% rather than down. We're optimistic about performance going into the second half of the year, not only on the back of the good performance in the first half, but also when we look at the quality, growth, and importantly valuation of the companies in our portfolio. It's also worth mentioning that over the last 7 years, small and mid caps have significantly underperformed large caps, and this has clearly been a headwind to absolute performance. But what we have noticed is that over the last 12 months, this trend seems to have stabilized. And of course, if it were to reverse, that could prove to be a significant boost to performance.